Hello and welcome. In our previous video, we saw why it is important to study credit risk and the role of credit ratings in credit risk assessment. In this video, we will look at what goes into rating a company. Should we as investors completely rely on ratings? Are there other measures of credit risk? What are the key financial measures and ratios needed in credit analysis? While performing credit analysis of a company, the main focus is on the company's ability to generate cash flow over the term of its debt obligation. To understand credit analysis, we recap some basics on bond valuation from our previous video. Globally, bond market has turned out to be a very important source of financing for both corporates and the government. You would be surprised to know that the total outstanding amount of bonds is much more than that of the equities. There are two types of bonds traded: investment grade bonds or high quality bonds, and speculative grade bonds or junk bonds. Government bonds are rated high as they are considered to be of high quality. Let us take an example of two companies. The AAA rated companies are generally the largest and strongest of companies. AAA rated issue is priced high because of lower default risk it carries and is less volatile. This is analogous to saying that good quality products generally come with a higher price. Hence, these are investment grade. The BBB rated ones are companies that have high risk. To attract investors, BBB rated issue is priced low and offer very high yields on their bonds. High rate of interest or yield is given to compensate these investors for the higher risk they take. Bottom line, bonds with higher price assure low risk but the yield is low. Bonds with lower price assures higher yield but with higher risk. Yield is inversely related to the price that you pay to buy. This inverse relationship between price and yield is called convex. If a AAA rated company issues 5-year bond with a yield of 6%, and BBB rated company may offer a yield of 10% on a similar bond to compete for financing and at lower price. You can observe this in the figure 1. A bond's price is determined by supply and demand and incorporates the market's beliefs about the likelihood of default. The market's beliefs about default can be seen by comparing its yield to that of a very safe bond. This is called the spread. The greater the spread of a firm, the higher would be the default probability. At an economic level, another measure of systemic risk is called default spread. The default spread is usually defined as the yield or return differential between long-term BAA corporate bonds and long-term AAA or US Treasury bonds. It changes as the overall economy goes through its ups and downs that impact businesses. If you want to know roughly the level of risk that businesses cannot honor their debts, then you want to look at this default spread. In the next figure, we look at the difference in yields between Moody's AAA and BAA corporate bonds. It is clearly visible that much risk was present in the 1920s, 1930s and 1940s, and also in several of the recent recessions, in particularly the previous one. This can give us a good indication of how much risk is there in the economy. Apart from default spread, another measure of economy-wide risk is the St. Louis Fed Financial Stress Index. This measures the degree of financial stress in the markets. It is a combination of various interest rates and spread. In the next figure, we observe that the stress has gone up during the credit crisis of 2008 and during the great lockdown due to COVID-19. That was for the economy. Now, what about for an individual firm? Let us next look at how to measure the likelihood of default for an individual firm. We would be discussing two measures of default risk at a firm level: the Altman's 1968 Z-score model. This is based on 5 key financial ratios and it relies on the information provided by the financial statements. Working capital divided by total assets, Now, working capital is the difference between the current assets of a company and its current liabilities. A positive working capital means that a company can meet its short-term financial obligations and still make funds available to invest and grow. In contrast, negative working capital means that a company will struggle to meet its short-term financial obligations because there are inadequate current assets. The next ratio, retained earnings to total assets. The retained earnings to total assets ratio shows the amount of retained earnings or losses in a company. A high retained earnings to total assets ratio shows that a company uses its retained earnings to fund capital expenditure. It shows that the company achieved profitability over the years and it does not need to rely on borrowings. The next ratio is earnings before interest and tax divided by total assets. EBIT, a measure of a company's profitability, refers to the ability of a company to generate profits solely from its operations. The EBIT to total assets ratio demonstrates a company's ability to generate enough revenues to stay profitable and fund ongoing operations and make debt payments. The next ratio is the market value of equity to total liabilities. The market value of the equity to total liabilities ratio shows the degree to which a company's market value would decline when it declares bankruptcy before the value of liabilities exceeds the value of assets in the balance sheet. A high market value of equity to total liabilities ratio can be interpreted to mean high investor confidence in the company's financial strength. The last ratio is sales to total assets. It is also called the asset turnover ratio. The sales to total assets ratio shows how efficiently the management uses assets to generate revenues vis-a-vis the competition. A high sales to total assets ratio is translated to mean that the management requires a small investment to generate sales, which increases the overall profitability of the company. The Z-score was built to predict whether a company is likely to go bankrupt in the next 2 years. It was developed by finance professor Edward I. Altman and is based on multiple corporate income and balance sheet values. The Z-score will signal 70% of bankruptcies of publicly listed companies and predicted the demise of Enron, WorldCom and other disasters. The Z-score is displayed on a bullet graph. A value below 1.81 indicates that the company is in significant distress and there's a high probability that the company will go bankrupt in the next 2 years. A value between 1.81 and 2.99 indicates that there's a good chance that the company will go bankrupt in the next 2 years. A value above 2.99 indicates that the company is in the safe zone. Accounting models use information derived from financial statements. Such information is inherently backward-looking, since financial statements aim to report a firm's past performance rather than its future prospects. In contrast, Merton's 1974 model uses the market value of a firm's equity in calculating its default risk. Market prices reflect investors' expectations about a firm's future performance. As a result, they contain forward-looking information which is better suited for calculating the likelihood that a firm may default in the future. The measures, such as a forward-looking probability of default, enabled regulators such as SEBI and RBI to foresee credit events for appropriate decision-making and to protect investor wealth in the stock market. In November 2019, SEBI has mandated companies to disclose any loan defaults from banks and financial institutions, wherein the default continued beyond 30 days. As on December 31, 2019, 60 companies have already disclosed a cumulative default amount of almost INR 75,000 crores. The formation of Indian Bankruptcy Code or IBC in May 2016 has paved way for a stricter regulation towards settling bankruptcy cases. We need to wait and watch how the IBC will change the face of bankruptcy in India. Thank you.